Welcome to Chapter 2 in Financial Accounting. I'm going to try to break this chapter up into no more, hopefully, than 15-minute videos because I've got some spaghetti sauce that I am making from scratch on the stove and it has to be stirred every 15 minutes. So hopefully for you, I will remember that and not burn my spaghetti sauce. So here we go. We are going to dive into the meat of accounting and start analyzing and recording transactions. Now, the first thing that we are going to do when we are presented with a scenario is we are going to look at things called source documents. And we will then take those source documents, analyze them, and start to think about, okay, what accounts are affected by these source documents? We can then record the entries in the 2 or more accounts that are affected and post those, and then that will lead us into being able to prepare our trial balance and financial statement at the period end. So what are source documents? These are things that you have probably seen throughout your life, throughout your day, maybe even today, but didn't really think of them in terms of being a source document. So these are bills, receipts, checks, purchase orders, bank statements, payroll records, anything like that. Basically, what that is a document that tells us, hey, something happened. So once we figure out that something happened, the question becomes then, what is it that happened? What accounts were impacted? And how are we going to record those? So as you can hopefully recall from our last chapter, we have this accounting equation that we have to keep in mind. We have assets equal liabilities plus equity. And this slide does a really nice job here of giving you some really concrete examples of what you're going to find in these various areas. Specifically, our assets are going to be things that we own. Probably things that we could touch. Certainly if you touch it, it's probably an asset. But just because we can't touch it, like accounts receivable, things like that, those things are still assets. Then we have our liability accounts. This is what we owe. So our accounts payable is usually what we owe to our trade vendors, our suppliers, things like that. Notes payable are going to be things that we owe maybe to banks that are of a more long-term formal lending arrangement. And then we'll talk more about accrued liabilities and unearned revenue as we go along. I don't want to add too much too quickly here. We then get to owner's equity, and hopefully you kind of remember the idea that, there is this umbrella of owner's equity, and under that umbrella we have 4 separate accounts. We have our owner's capital, and then owner's withdrawals, revenues, and expenses. And again, this is sort of a longer version of the interplay between the various aspects of the owner's capital. So we have owner's capital, but we then reduce any withdrawals, any money the owner took out by, so owner's capital is reduced by owner's withdrawal. But any money that we earn increases owner's equity, but then the money that we spent on expenses decreases owner's equity. So we have all of these accounts that we keep track of in what is called a chart of accounts. And this is an example of a chart of accounts that lists all the individual asset accounts, liability accounts, equity accounts for this particular company. You might have a company that could have a vastly larger chart of accounts because their transactions involve many more types of things that they have to keep track of. But the chart of accounts are basically a list of all the accounts housed under each of the assets, liabilities, and equity sort of umbrella. And so those are the accounts that we are going to be using once we've analyzed our source documents and it's time to decide what accounts those transactions fit into. Debits and credits. And there is a brief video in this week's overview module that is just a little funny YouTube video that I post up there, but hopefully it will help you remember this fundamental concept. Debits are on the left side, credits are on the right. Left and right of what, you say? This is something that is called a T account, and it's called that because it's kind of shaped in the form of a T. We've got the title here at the top, and there's a left side and a right side, debits and credits. Now, it would be lovely if I could tell you that debits all behave the same way no matter what account we're dealing with, and credits all behave the same way no matter what account we're dealing with. But unfortunately, I can't tell you that. How a debit or credit behaves depends on what kind of an account that we're dealing with. So we'll take assets first. Probably the clearest, and I think students find this an easy one to start with. So you'll notice here in this T under the assets, any asset account that is increased. So when we receive cash, for example, and cash as an asset, that's going to get recorded on the debit side of the T. When we spend cash and cash goes out, that gets recorded on the right side or the credit side of the T. And this is a chart that I strongly encourage you to cut out. It's in the notes slides. Keep this someplace pasted in your laptop or notebook or whatever it is, and there will be a point at which you will automatically remember whether a debit or a credit increases or decreases a particular account. But until you've committed that to memory, it's okay to have this kind of as a little crutch to help you along as you're doing your homework. So when we see again that debits are increased in an asset account, a debit is an increase and a credit is a decrease. Now we come on over here to the liability side, and you will see that it is exactly the opposite. So when our liabilities go up, when we have more debt, that is a credit. When we pay down some of our debt, that is a debit. And then when we get to owner's equity, it gets a little bit more complicated than this basic slide will show you, and I'm going to skip on to the next one. And actually, perhaps this is a better slide for you to copy and keep in your notes, because it talks specifically about how the 4 different types of accounts under the owner's equity umbrella are treated. So you'll notice that under the owner's capital, a credit, owner's capital is increased by a credit entry, decreased by a debit. On the other hand, the owner's withdrawal is increased by a debit, decreased by a credit. And if you think about it, I had said these two kind of offset each other because the owner's capital is going to be offset by any money the owner took out of it. So it kind of stands to reason that these two would be opposite. Similarly, we get over here to our revenue and expenses, and we see kind of a similar relationship. When we earn revenue and our revenue goes up, that's a credit. Looking over here at our expenses, when our expenses go up, that's a debit. And that is how basically our expenses offset our revenue. And if this is starting to sound overwhelming at this point, that's okay. We'll just continue to go over it, and hopefully it will start to congeal. If it's not sounding overwhelming, consider yourself lucky, and we will move on. So we have what is called a double entry accounting system. And for every transaction that we have, the total of the debits and the total of the credits must equal. And we will end up with each account having a balance at the end. Now, you will see here that if we were to add up these two columns, the debit side being 36,100 and the credit side being 31,300, that leaves us a balance of $4,800. And that balance is on the debit side because that's the larger side of the transaction. So if we said, how much is in the cash account? The answer to that question would be, oh, the cash account has a $4,800 debit balance. And let's see, just pause here for a second. I think this is an excellent time to go stir the tomato sauce because I will run over 15 minutes for sure. And so I will do that, and I will see you on the next video.